Hey traders, hope you guys are good and welcome to my learning space. If you're new to this channel, my name is Dumelo, and in this channel we talk about everything Forex. Now, if you're interested in this type of content, make sure that you do smash the subscribe button below. Also turn on the notification bell so that you can be notified whenever I drop a new video. If you're a returning subscriber, welcome back, and I hope you enjoy today's presentation. Now, without wasting any time, let's get right into it. I'm trying to keep this video short. So yeah, the idea behind leverage is that you can purchase an asset, an expensive asset, but you don't have to match that offer from your own coffers, right? I had to pause there for an effect so that it sinks. So say, for example, you want to purchase a house, right? And that house is on the market for 2 million rands. Now, leverage says that you do not have to have all of the 2 million that's required to purchase that property. So instead, what you will have is a down payment. That's a portion of the 2 million. And the rest of the 2 million will be financed through a bank. So you go to the bank and you're like, "Ayo, I want to purchase a property, it's worth 2 million." And then the bank will go through its own processes to determine whether or not you are suitable to get that loan. And if you meet their criteria, they'll give you that loan. So they're going to buy that house on your behalf. And in return, what they expect from you is a monthly payment. The same thing happens with cars. So say, for example, a car is on the market for 500,000. Not a lot of people have 500,000 lying around. So what will you do? You will save a deposit, which is a portion of that 500,000. You will go to the bank and be like, "Ayo, bank, I need to buy a car. Please buy this car or finance this car, purchase it on my behalf, and I will pay you in interest." The same thing happens in the financial market space, just that the process to doing that is a bit different to what we used to with banks and with cars. The main idea is that you want to purchase an asset, but you don't have a lot of capital. So what you will do is you will receive a loan. In this context, you receive a loan from your broker, and then you're going to be able to purchase that asset, and then you have to pay your broker back. So how do we define leverage? It's the amount of money that you borrow from a broker to open a position on a currency pair or on a stock, right? Now, in the other examples, I was talking about down payments and deposits, right? In this instance, we have what we call margin. And if I remember, or if I get the time in the near future, I'll do a separate video on this. So when you purchase a house, there's going to be a minimum sum or a minimum amount of cash that's going to be required for you to put down as a deposit or as a down payment for you to purchase that property. Same thing with currencies. There's a minimum amount of money that you're required to deposit, right? So let's look at currencies, for example. In the Forex space, if you look at your currency pairs, there aren't a lot of moves being made, especially within a day, within a week. The market can move, or the movement ranges between 0.01% and the most volatility that you can find during the day is like 4% or 5%. And so really, if you're going to be capitalizing on those movements on a regular basis, you're not going to make a lot of money. So for you to make money from those movements, what you need to do is you need to purchase a lot of units of a single currency. Am I making sense? And the more units you purchase, the more money you can make. If you've already been trading, the higher the lot size is, the higher the profit potential. So say, for example, you want to purchase the minimum, which is 1,000. A micro lot is 0.01. You needed this to open a position, right? What you're going to do is that with margin, you're only going to be required to have a portion of this. Now, a broker might come to you and say, you know what, for every $1 you have in your account, I'm going to give you $100. It means for you to open this position, you will not need $1,000, but you're going to need $1,000 divided by 100, which is $10. So $10 gives you the same buying power as $1,000. And that's just the basic idea behind this concept. You're using debt that comes from the broker to have a greater exposure to the market. Obviously, with this exposure to risk, there is a few cons and a few pros to this. Now let's get to the pros. I have a higher return on capital, right? And then also the returns are limited. So there's no cap to how much money you can make, depending on how good and how right you are, right? Another pro, losses are limited in a sense that you can't lose more than your margin, right? But obviously, this has a few cons. Well, one, I can only think of one con, right? So this is the con. The higher the leverage you use, the less room you have for error. Because the higher the risk or the higher the reward, the higher the risk, right? And so one other thing that's good with leverage is that if you had $1,000, if you didn't use leverage, that would have all been spent on one position. But with leverage, you are able to take this $1,000 and diversify that as much as you can, meaning you can open multiple positions. And then at the same time, with that diversification, like diversification is a means of mitigating risk. So instead of putting all of your eggs into one basket, you can literally take portions of your capital, put it in multiple positions, and one will pop. That's just the basic idea behind it. So that's leverage, guys. I hope this explanation made sense. If you have questions, feel free to ask in the comment section below. And I'm definitely going to release another video talking specifically on margins and position sizing. So make sure that you keep a lookout for that. But for now, this is all I have for you guys. Peace.